Wanted to highlight that I published my initiation report on Dalrymple Bay Infrastructure yesterday, so the stock's trading under the code DBI. Just as a reminder, DBI owns Dalrymple Bay Coal Terminal, which is a coal export terminal providing its customers with the ability to process coal from rail through onto ship for export, based in Mackay in Queensland. It's the cheapest route to market for its coal customers within that Goonyella rail system in Queensland. If it was to rail north to Abbott Point or south to Gladstone, it'd be a lot more expensive, somewhere around about at least $3 per tonne more for those customers. So certainly in a good cost competitive position. It's the only coal terminal in Australia that is regulated. Now, as we know, DBI is pushing for the terminal to have a change in its regulation. So it wants to transition from heavy-handed regulation. So that's where the Queensland Competition Authority sets its revenues, to light-handed regulation. And that's where it negotiates directly with its customers. And if there's a dispute, then the QCA steps in and arbitrates, but arbitrates based on a different set of principles to underneath the heavy-handed regulation. So whether it ends up being heavy-handed reg or light-handed regulation, it's going to apply from 1st of July this year, because the current 5-year regulatory cycle expires on the 30th of this year. So, look, I've set my base case on the basis that it actually transitions to light-handed regulation. I think there's some really strong logic to why it will actually transition to that. So, revenue improvement, if it does go through that light-handed regulation and negotiate with their customers, plus the likely material fall in interest costs that are going to come through as they've got an existing interest rate swaps that'll expire and get repriced way lower. I think that'll cause a very large increase in funds from operations. So effectively, EBITDA less net interest paid. I think there's possibly a 50% increase in that FFO will actually come through. So very material. If the heavy-handed remains, well, the revenue decrease that may come through because of interest rate pressures on the regulated cost of capital will be mostly offset, I think, by the fall in the interest costs. So that FFO relatively unchanged, if not a little bit of a downside to it. So just on the stock, obviously the stock's come off at IPO. Reminder, IPO price was $2.57. It got down close to $2 yesterday, but closed at $2.12. In terms of yield, so DBI, you might remember, committed to a 7% yield on its IPO price. With where the stock is yesterday, that's around about 8.6, 8.7% now. That puts it at the very top of the range of industrial companies on the ASX 300 at the moment. So right up the top there. To me, that's pretty unreasonably high, i.e. actually very attractive given the risk mitigants and the potential for earnings growth that this stock has. So as a reminder, the risk mitigants, it has no volume risk because it's take or pay contracts. It has no customer contractor capacity risk because of the revenue socialisation concept within the regulatory regime. It does not face force majeure risk, which is very important because the terminal sits up in tropical Queensland, and floods and cyclones come through there all the time. All the terminal operating costs is a direct pass through to the user group. Any capital that gets spent gets rolled into the regulated asset base or the asset base going forwards, upon which they can actually earn more revenues from. So, and I should also point out that even though we may look at their customer group and say, well, there's a risk in low coal prices that customers default, DBCT has never had a customer default on payment in its life since, I think it was like early 2000s that it was actually built. So very strong on that front. Is the distribution sustainable? Well, we should point out that within its prospectus, it committed to a 1% to 2% per annum distribution growth. And the cash generation and the risk mitigants, as I was saying, are very strong. How much growth, I think, depends on just those revenue outcomes plus the capital expenditure that they need to spend going forward. I've assumed a mid 1.5% or 1.5% sort of distribution growth going forwards, but we'll just see how that plays out. I've set a $2.50 target price. That's predicated very much on the light-handed regulation going through, and also I think we need to sort of point out, because a pushback will be asset stranding risk. The concept here is that met coal from Queensland will continue to be processed through DBCT for the very long term. On that basis, 20% upside in terms of share price, add in that very high distribution yield, you're getting high 20, close to 30% total return. So got the ad rating on the stock. I have, for those doubters out there, put in a valuation scenario under the heavy-handed regulation. Obviously, the returns are nowhere near as good. And with the high level of gearing that the stock has, so it's 75% of its asset base is geared, the movement in the enterprise value is very much accentuated at the equity value level. So it's a $1.50 type valuation in a harsh, heavy-handed regulation scenario. So for those out there that are sort of thinking catalyst, next key events, February, we should have the result coming out, as well as the QCA's final decision on that transition to heavy-handed regulation. There's also a process that DBI has been running where it's actually trying to get regulation canned altogether, so revocation of regulation. There's a decision due on that. They're going through judicial review, so there's a decision due on that this year, potentially in the first half. So if that comes through, the QCA is out of the process altogether. Wouldn't be right of me as an analyst if I didn't point out sort of long-term risks, and without a doubt, that exposure, 100% exposure to coal is the big one, and with that is the ESG headwinds and also the potential substitution risk that goes with that. But I think this stock is pretty compelling at where it's sitting at the moment in terms of share price.